Friends, good morning and welcome to yet another edition of the Multimillionaire Forum. This is a forum where we do a little session on the first Saturday of every month. And what we do here is we bring some idea, something which is happening in the economy, something that is happening in the world, and we do a little analysis and put it together. Purely knowledge sharing. We do not recommend any products here. We don't speak about any products here. We don't sell anything here or even later for that matter. So this is a purely education and information initiative from our end, and that's the endeavor of this forum. So moving on, that's pretty much the disclaimer I already spoke about. So today we have a slightly different topic, and the topic is about fixed deposit investing, but not exactly fixed deposit investing, something that could be better than fixed deposit. So what happens more or less and most of the time is that we want to have an investment which is absolutely safe, which is absolutely steady. There is nothing that goes wrong with an investment. And we, along with having safety of money, we also would like to have a situation where, you know, money grows over a period of time, the tax is lower, and if possible, we can have like a monthly, payout coming into us on, month after month, and preferably, year after year without any break or without any interruption. So these are some of the things that we want. A lot of us also would like to have an investment which does not involve the equity markets. Um, and can we then still do something which is better than the fixed deposits? The problem of fixed deposits is that the rate of interest on fixed deposit is that 6 or 7%. And the unfortunate bit is that even if you put 100 rupees on that, or for that matter, a crore of rupees, every year inflation is doing its job. So things get expensive as we move along, which we all know. And over a period of time, it becomes a bit challenging to be able to manage expenses and cash flows in the same deposit money coming in, because the bank is going to move in its own method and direction. But for us, it's a little bit of a challenge because we need an incremental flow. So there are two things that normally we will want to do, right? One is we would like to invest with a higher rate of interest fixed deposit, uh, which is why then, there is a little bit of risk that is there in that, because then it may not be the blue chip company, it may not be AAA rated, it may not be with a bank, it may have to be with a private entity, or a, not so well known kind of an entity, but that's where the rate of interest moves up. But then there is risk on capital also, right? Then some people like to mix it up with equity. So what we are going to present to you is three ideas here. And there are ideas which we can still implement, and we do this on a yearly basis. So every year we have intended to, have one session on fixed income. And the timing is also quite opportune right now, because we are seeing an interest rate cycle. So just to speak about what an interest rate cycle is, every time there is a cut in the interest rate or interest rate moves down, the fixed deposit investor obviously gets a little lesser rate. But as a result of which, what happens is there is a whole lot of economic movement that starts happening. And sometimes these funds that we are investing into, these fixed deposit or debt oriented funds, as they are known, DEBT, debt oriented funds, in mutual funds, they tend to make a little bit of extra profit. So just remember one simple rule, that if the interest rates go down, yes, the bank will give you a little lesser rate. But if you are already invested in a debt fund, now debt fund also has a lot of varieties, but leaving aside the very, very short-term variety, which is basically investment that is done for one day to maybe 1 week or maybe 3 months, uh, other than that, most of the funds would make a little money when the interest rates go down, you see. It's quite interesting, but we can speak about that in Q&A. Now let's roll and let's talk about the three, ideas that we wanted to talk about. So what we identified is three different type of investment strategies. Some of you may already be doing this, and otherwise it's just a great, nice to know kind of a thing. because you will always know somebody who wants to do an equity investment, sorry, a debt investment, but wants a little better sort of a return on that investment, maybe 2%, maybe 3% more than the bank fixed deposit. And if you can save tax on that, why not? That's a fabulous thing to happen, because fixed deposits, as you know, are charged at the highest level of tax, versus on the other side, equity investments are charged at the lowest level of tax. So there's a bit of a trade-off there. But let's sort of dig into this thing, and let's speak about the special debt fund, which is a fund which has got absolutely zero equity exposure. Okay, so as you can see here, the composition of this product is very interesting, right? What SOV stands for is basically sovereign. Sovereign means basically something that is guaranteed by the government of India. That's what sovereign means. All right. Triple A, what for some of you who may be aware, this is a credit rating. So when you are giving money to a company, and this is largely applicable for large companies and not private companies, because it's an expensive activity to do to get your fixed deposit program rated. Okay. So this is a rating. These ratings are issued by rating agencies like CRISIL, ICRA, etc. Right. So when they give somebody a triple A rating, what that means is that this particular company is very high or highly rated in terms of security of principal and regularity of interest payment, to make it very simple. Double A, as good as triple A, but maybe a tad lesser, but it's still a very good investment. Now, there are some people in the world, different rating agencies have their different styles. Somebody would say double A plus, double A minus, triple A. I mean, they just have this plus minus signs to just kind of make it even more interesting. What's also very interesting is this particular debt fund, this special debt fund has a little bit of real estate in that. And this is zero equity, okay? This is absolutely no risk of the equity market whatsoever. Now, look at what you see in front of you. I'm sure by now these returns have already got your attention. Just look at these returns. Okay, these returns are last 1 year 12%, last 1 year 20. I mean, this almost looks like an equity return. It sounds unbelievable, but this 21% is a bit of an outlier. It doesn't happen all the time. Our session's title today is Sustainable 10% Solutions. What I mean by that is, okay, what's sustainable and why this entire theme. Let me sort of step back for a moment and just talk about this theme. So sustainable 10% means a investment that gives you a 10% sustainable return for an enormously long period of time. And that enormously long period means we are talking in terms of 5 years and 10 years without interruption. Now, it may not make 20 and 30% like the equity funds do. It may not even make the 1 or 2% again, which the equity funds do, but it always kind of hovers around in a steady range. Let us say the range being from about 7% to 12%. It's quite a range, and the average being about 10%. So that is the logic of creating and putting all this data and information together, that there are very interesting products that we could look at. And these products basically are like a mix of everything. Like I showed you, bring the presentation back. So it's got sovereign investments. Now, okay, let's for a minute talk about what are sovereign investments, right? So sovereign investments are, the loan programs of the government, basically in very simple terms. These are, borrowings made by the central government, state governments. Obviously, there is no risk to the capital there. Triple A and double A, I explained how, this works out. A little bit of real estate and equity. Now, these funds, like I said, so I just wanted to highlight here that this 21%, and it's a bit of an anomaly, but this 14 is possible, 9 is possible, 10 is possible, 12. We should not, what I'm trying to say is, you should not expect that these returns will happen all the time, because even this particular idea, remember, it is zero equity, right? How do these things happen? So let's kind of dig a little deeper and say that, without any equity participation, how is it that these funds have generated such fantastic returns? Okay, so let's move on to the next slide and let's understand them a little better. Okay, so here it is. So there are these debt funds which are known as medium term category. Okay. Now, like I said, see, debt fund also is like a massive universe. Like, okay, let's talk about debt fund universe for just a minute. Okay, I'm kind of continuously digressing because anybody who's going to see it is going to wonder what is a debt fund. So let's just talk about debt fund. So the debt fund, very simply put, is uh, it's a much more sophisticated way versus doing an FD investment. See, when you make an FD investment, you just simply go to your bank, put your money, and the bank says, I'll give you 6%, 6.5%, and the story is over. But debt mutual funds is like a whole variety of things. If you wanted to park your money, just let's say for the weekend, for 2 days, then there is an option called treasury bills. So you give the money to a mutual fund and he will put your money in treasury bills. Treasury bills basically mean bills which are issued by Reserve Bank of India. And these bills have a very short maturity from 7 days to 30 days and 91 days, etc. Very safe, Reserve Bank of India, no question about any default whatsoever. So debt funds have investment horizons ranging from, like I said, from 1 week to as much as maybe 10 years that you can be invested. So on the lowest level is this treasury bonds that will obviously earn you about 4%, 5% per annum. Then the next is what they call is a liquid fund. Then above that, what they call is a short-term fund. Above the short-term fund is what they call a medium-term fund. And above the medium term would be a long-term kind of a fund. Then there are things like dynamic bond fund. Now, what these different categories of debt funds mean is that the mutual fund manager will accumulate monies from all of us retail investors, make a pool of it. And for example, if he's in a dynamic bond fund, so dynamic, as the name would suggest, he can invest into a whole variety of fixed interest instruments, right? So he can go and he can place fixed deposit with 3 banks. He can participate into some debenture program of 3 companies. He can do some private companies fixed deposit, which are obviously AAA rated and things like that. He can give money to the central government. He can give money to the state government. So he can give money to state government and central government companies. So again, which is as good as a government guarantee on that. So there is, as you can understand, the playground is enormous and there are a lot of options in that space also. And by the way, you might be also, surprised to know that the volumes or the transaction volume of these bond markets are sometimes, and not sometimes, very often, and most of the times, much higher than the equity market. If you guys can just do a little Google and find out what is the transaction volume for the bond market, just by the way, Praveen can do it, and we'll tell our friends on that. But so that's the debt market for you. So there's a lot of variety in the debt space also. And that's the kind of composition that you saw. So what we were showing you is basically an example that this is what these medium term funds have. So these medium terms, they basically have this is all sovereign category, right? Sovereign means GOI. GOI means Government of India. Okay, let me decipher what this entire investment means. Okay, this is Government of India. The GOI stands for Government of India. SEC stands for security. Government of India security. This thing that you see here, 6.79. Let me remove my drawing so that you can see it clearly. 6.79, what you see here. This 6.79 is the rate of interest of this particular product. So the Government of India, typically these are 10-year products. So the Government of India, and maybe in 2024, and exactly the date would be 7th of October 2024, they came out with this program or this bond saying, please everybody give me money and I will give you a 6.79% interest rate. And the maturity of this product is going to be 2034. You see, that is what this entire product means. So likewise, this product, this product here, what this means is this is a Government of India security. Rate of interest is 7.18%, and it was issued obviously 10 years ago on 14/8/2023, and maturity, as you can see, is in 2033. So these are products. And like I said, remember, when the interest rates go down, these products jump. There is capital gains that happen. Don't worry too much about bond economics, but just understand that these investments are, when you see SOV rating, you can just absolutely don't, there's no second thoughts. because this is guaranteed by the government of India. So if it's guaranteed by government of India means if the government fails, our investment will fail. Otherwise, everything's good. And then, of course, you have a whole range of AA and AAA companies. So this is a particular product. And like I said, we don't speak product names, but this is just again to give you an example that look at how much money is invested in sovereign. They have almost invested 22% of their money in sovereign. And as you can see, this is another about 20% money into AA and AAA. And the list goes on. This is just to give you an idea that this kind of an investment is known as a medium-term debt fund, and that's the capability that it has. Let's show some more examples. Okay, see, this is a very different kind of a fund, okay? As you can see, right now, I just want you to focus on companies that are invested here. So this is an investment, this is an infrastructure project in which they have invested 9%. Then I just want you to focus on the names of the companies. This is Aditya Birla, this is Tata Housing, this is Nirma, this is JW Steel. Again, this is Government of India, this is Tata Company again, Aadhar Housing, National Bank for Agriculture, which is a government-owned company again. Okay, these are the companies. Credit risk. I want to talk about credit risk for a minute. So what does credit risk mean? Okay, can you take the presentation off? See, credit risk is a very interesting category of debt mutual funds and which most of the investors pretty much ignore. But this is a slightly high risk thing. But when I say high risk, please again understand there is zero equity in this. Okay, high risk means there is a risk of default, right? See what happens when you give a loan. I'm sure all of you have thought about loans, that you have given loans to somebody in your life or you have taken loans from someone. But very often you see in friends and family also, very often you've given a loan, the money sometimes doesn't come back. Obviously, that's known as a default. Some people, and most of the people are quite honest about it. So they will pay the interest on time and also repay you the capital when the time is due. But that is private lending, right? Which is happening between you and me and, individually. It happens all the time. No big deal about it. But then a slightly more organized way of lending is that I give money to a bank as a fixed deposit, and then the bank lends it as whatever product, car loan, home loan, working capital loan, OD loan to a company or an individual. That's basically what happens. Something similar happens with NBFC also, that I get a slightly higher fixed deposit rate, and the NBFC also goes and does the same thing. Now, we have given money to a mutual fund here. The mutual fund in turn is giving money to a bank, to the government, to NBFC, to everybody else. But the category of investment that the mutual fund here is doing, and like you saw, all the corporate names, very respectable corporate names, right? What this means is they are giving money as loans. The mutual fund, mind you, listen to this carefully. The mutual fund is giving our money as loans to these very, very well-reputed blue chip corporate names. Not saying that default cannot happen. A Tata company can technically and theoretically default, but we know that Tata is being Tata's, the chances of default is near zero. It is almost like government of India, but it is not government of India, right? And that way, in the same fashion, Aditya Birla, maybe 100-year-old housing sort of a name, household name, a Bajaj or an HDFC, these are all household names. Nothing can happen to them. Nirma, I mean, forever, we have known about Nirma. So these are very well-reputed companies. And these companies also need to have borrowings from time to time for their business to grow and for their expansion and other projects that they want to do, right? So they need capital. So this is one great way of raising capital for them. And we give the money to a mutual fund. We don't have the capability to give money to a Nirma or a Tata or a Bajaj on our own. So the mutual fund manager does it for us. And he does this under the label of credit risk funds. That's the category. Okay. So bring it back. So that's why I wanted to spend a little bit of time on this, because this is a very, very interesting thing. And there are products which have consistently given you very, very good returns. And in sometimes when the interest rate goes down, in the year in which the interest rate goes down, this category of a fund just jumps up in return. But hey, what is the risk? Why is the word risk used here? The opposite is also true. So when the interest rates are increased, now we won't see that for the next few years, but when the interest rate goes up in the country, these funds will lose a little capital gain. Okay, so these will fall also a little bit faster. In those years, these funds could return about maybe 5 or 6%, but will not become zero. Okay, so something to understand. Now let's move to the next category. Now, here see what happens in this category. As you saw, now the returns are much lower than the one with zero risk. And you might actually start wondering that this particular category of funds has got an equity component also in this. It's got a equity. So now what happens is there are these debt funds which are known as conservative hybrid, where 70 to 80% and sometimes even 85% of the money is only into bonds and debt funds or debt investments, right? Now you understand what debt investing is. What is a debt investment? Central government, state government, central government and state government owned companies, AAA and AA rated companies, and banks, fixed deposits, etc. NBFC fixed deposit. So that is the universe of all this debt mutual fund, right? That part you have understood clearly. So what does a conservative hybrid category do? 70 to 80% of your money, it invests in these kind of products, these debt products, okay? But it has a little bit of, it needs a little bit tadka, like, the way we say that, little spiciness, little, seasoning, if you like. So what they do is they put some equity component in this. So you know that the debt investment, if the fixed deposit rate is say 7%, your debt mutual fund will do 7 or a little better than 7, maybe 8, maybe 8.5. Then what happens is with this equity percentage or equity, little bit of equity seasoning that they put, the return jump up. So the point to note is this 3-year return particularly. We have just shown you, 1, 2, and 3, all the options. The reason for that, I'll speak about that in a moment. But the focus should be on the 3 years. See, 10%, 10%. And the same thing happens for 4 years, 5 years, 7 years, 10 years, whatever. The consistency of returns is somewhere around 9 to 10%. Okay, that goes on and on. But this 30% has a very, very tiny element of risk. Like you see, this last 1 year, the equity markets have been a little silent, right? So the returns fell from the 9 and 10% to about 6 odd percent, a shade below the 6, 5.95. And this is, by the way, this is just last 365 days. In the last few days, last week, the market has fallen a little bit. So this number is now looking below 6. But maybe 2 months back, this number was looking at about 7.5 or 8%. So it's a dynamic number, but we are showing you the latest data. So don't go on the assumption that this 6% is permanent. This number changes. This particular number changes every day. Okay. So in a medium market where there is neither a massive rally nor there is a massive crash, you should see a number of about 7 to 8% here. Okay, and what this equity does is it adds another 1 or 2%. It gives a seasoning of just 1 or 2% more. So investor gets about 10%, and the investor experience is very, very good and a fantastic option versus the fixed deposit. I mean, actually, I should not say fantastic. The fantastic is that one is coming afterward. This is a much better option than your traditional fixed deposit because the tax is the same, mind you. In the pure debt, the tax is maximum. What is the tax in fixed deposit? Let's speak about tax for a moment. So taxation in fixed deposit is the highest. If you are in 30% category, your tax is 30%. If you are into these debt funds, then your tax is 30% or whatever, 30% plus surcharge plus cess and all that, right? If you're in this conservative hybrid, your tax is still the highest, 30% and plus whatever. So therefore, instead of paying 30% tax on a 7% deposit, if you were to pay 30% tax on a 9 or a 10% investment, obviously you would have some more money, some more cash flow in your hand. That's the submission of this conservative hybrid category. Okay. And now let's move to the best part. Okay, we saved the best. Oh, by the way, these are some examples. Okay, sorry, I forgot. Okay, let us just, for sake of completeness, just speak about some of these things. So as you can see, this is an example of Maharashtra State SDL. Let me decipher what this means. Maharashtra is the state, very clear. SDL means State Development Loan. So this loan, also these products could be 5 to 10 years. I believe this would be a 10-year product. And 7.33 is the rate of interest the Maharashtra government was ready to pay when they launched this investment 10 years ago, say in 2021, and the maturity being 2031. That's basically what this means. Okay. And let's also talk about now. See, Power Finance Corporation debenture. This is a very nice example of a government-owned company or a company in which the government is the largest stakeholder. Okay, so what they have done is they have issued a debenture. Debenture is another form of, in very loose terms, like a deposit. Basically, you give money, you get interest. Very simple. But debenture has certain other properties other than a fixed deposit. But it is almost like a very simple interest-bearing product. We are not getting into the economic understanding of all of this. But debenture is another name for a fixed income product. 6.64 was the rate of interest. And maybe this was offered 10 years ago. That's why the maturity date is saying 15th of July 2030. So these are just examples. National Bank for Agriculture, some same similar example. This is another product. Again, this is just to show you that this product has a slightly different variety. See, the fund manager has, a lot of freedom in this within the broad boundaries. So here in this particular product, the fund manager has invested almost 45% of his money in government sovereign securities. So safety level being extremely high. And then, of course, he is into some government-owned companies. And here, Bajaj Finance debenture also you can see. So very nice, reputed companies. That's what they do. And they bring home 10% in a very conformed, in a very nice manner. Okay. Now, here's the best part, okay, which I saved for the last. Why this is very good. So this is like the conservative hybrid, the one that we were just talking about, which also had equity of 30%, right? This one has a max equity of, say, 35%, as you can see. So what's the difference between this one and the previous one? In the previous one, in the conservative hybrid, your tax was 30%. Okay. And in this particular product, the tax is just 12.5%. So imagine now you are making the same FD kind of investment, but with a little seasoning, with a little spiciness of equity. But like this says, maximum 35. That doesn't mean that the fund manager will always have 35. He may even have 25. He may even have 20, depending on the situation. But the very interesting innovation about this product is this hedged equity. You know what this hedged equity means? Very interesting, okay? Hedged equity of 30% means they are into shares, but they are doing simultaneous investment. What this means is they buy at one place and they immediately sell, and they try and earn a little spread. This is not risky. This is very standard operating procedure. So what happens is, if I may just write this part, okay, this is equity, this is hedged equity, and this is debt. So the hedged equity portion is only going to earn the 7% because he is buying and selling simultaneously. It's a very well established thing. Institutions do this. As individuals, we don't do this kind of work because you need big volumes and you need a terminal to work with and things like that. But this is an institutional activity. So in a hedged equity, basically, it's like a debt fund investment. They earn 7%. The debt itself will earn again, say 7%, plus minus, of course. And the equity will obviously earn a little more, say 12 to 14%, correct? So combination of that is what comes as returns. So the returns between this special hybrid and conservative hybrid is not very different. Returns are, again, about approximately 10 to 11%. Some better years you have 12 and 13% also. But the beauty of this is the tax is just crashed. So imagine if you are in 30% category with cess and surcharge, you're probably paying 33, 34% tax, and your tax is down to 12.5%. Why? Because, why does this happen? Because of this species called hedged equity, a beautiful innovation, like I said. The earning of this portion of the portfolio, like I said, again, I'm repeating, money is divided into three parts, right? Equity, hybrid equity, and debt. Equity has max of 35%, hybrid equity 30, and debt is obviously 35%, right? So it is because of this category, what happens is this particular kind of fund gets a special treatment, and thereby the long-term capital gain is applicable on this at 12.5% and not the 30%, which is the maximum tax. This is a very interesting idea for all senior citizens, for everybody. And this is something that you may have seen in your portfolios if you are managing them, or you may have seen us talking about it individually. But this is a fund which a lot of times we suggest, whereby people can make an investment here and earn 10 to 11% consistently. By the way, these products are so good. In the last 10 years, there are some products, not some, many products, I should say, which have consistently given year on year positive returns. Do we have that slide? Can we show that? Do we have that picture? Yes, yes, this is what I was talking about. Can you see this? We have obviously, obvious reasons, we have not recommended any names. That's why we've taken out. But this is the year 2015. These are annual returns, okay? Look at this. In the last 10 years, only one negative, and that too of 0.55% negative return for 1 year. Otherwise, all the years positive return. Average return being obviously about 10 to 11%. This is a product which has got, this is a product which has only 5 years history, but minus 1.55. That's all. Okay, look at these two products. My goodness, not a single negative year. Look at them. Let's study this. Let me remove my drawings, and I want you to, for a 2-minute study. I hope everybody can see that. If you can't, please tell me. But this is the category. Look at this. In 2015, 2016, 17, 8, etc. Every year, the lowest return it gave in a particular year was 1.32% positive in 2018, when there was a massive problem in the financial markets. But otherwise, can you see? Not a single negative year. Now, okay, you may think that, okay, some years we have got 5% and 4% also, so it's not really consistent 10%. So what happens in the financial market, we actually look at what's happening not so many years ago, because it's not equity market. There's no compounding effect, right? We look at the last 5 years of data, mostly, okay, from 20 to 24 or 25. We look at that kind of data because it's more relevant, it's more current, it's more of the current, it's more demonstrative of the current situation, right? So we see that the rates are nice double digits. Not to say that they cannot go down there. Yes, they can go down there, but then in certain years we are looking at 10%, right? Our aim is 10 to 11%, or maybe 9 to 11 is our range. There are years in which here we got 3% surplus, 1.6% surplus. Here we got again 3% surplus. So if you add this surplus here, here, and here, in the year which you get bad returns, the average works out still 10%. So if you were invested in this fund and every year you were withdrawing about, say, 8%, 9%, 10% from this fund, your fund would never be, generally it would never dip below its capital value also. It will always be there. Even if it dips momentarily for a month or two, it could happen in the first 15 or 20 months, that it might just dip for maybe 1 or 2 months or 3 months below. But because it's all interest payment, right, it will automatically always come up. So that's a very, very powerful and very interesting category. Okay. So typically what happens is when you also sort of move towards retirement, or when you want to take lesser risk on your or lesser volatility on your investment, we shift money into these kind of fund from which a stream of payments is generally made, because we want our stream of payments to not suffer. So, and we want our cash flows, monthly cash flows and monthly expenses to not be at the mercy of the equity markets. And that's the reason we get into these special hybrids and conservative hybrids. Okay. Do we have anything else? Okay. This is just to give you an example of, the variety of holdings that we have. So as you can see, there is some, okay, real estate. I must a little point to mention on real estate. See, you see this Brookfield real estate, this Mindspace real estate. So what is happening is these funds, when they say real estate, they don't actually go and invest with a builder or, that kind of a property. What they do is they invest money into a real estate investment trust. It's a new vehicle which was launched a couple of years ago. But basically, it is this investment vehicle which then has its own due diligence and everything. And then they go ahead and buy rental properties and things like that, pre-leased properties. So the cash flow is much more steadier. And these are very large buildings, which are made only for rental. They are not the buildings that are made which are sold to individuals and who onward do a rental. No, this is like a Mindspace, or, they make a huge commercial complex, and it is only meant for people to rent. Nobody can ever buy there. Whoever makes it is always the owner. There is no second owner in that. They only do it for purpose of renting. So, and then those properties, investment in those rentals can be done through this real estate investment trust. Basically, that's what it is. Okay, let's move on. Okay, these are just some other varieties of the same products. Okay. Okay, this is, I already spoke about this thing, the explanation of what these different terms mean. And I think that's about what we have. I mean, this can go. So I think this sustainable 10% solution, see, last year also we spoke, you can remove the presentation. So last year also we spoke about this. And last year the product focus was a little different. And this year the product focus is a little different. It doesn't change every year. And we are trying to make it more uniform year after year. And the intention is in that sustainable 10% solution, year after year, we bring you updates. And we probably will do this every year in the month of September. No particular reason why, but it's just, for the sake of uniformity, we are intending to do this year after year. So very, very powerful, very simple, much better than fixed deposits. And God sent, I can tell, for a fixed deposit investor. And with the innovation that we have in the mutual fund space, these are fantastic funds to consider. They will never do, I mean, they will sometimes do 18 and 20, but very rare. And you can't be, banking on that. But 10, 12%, absolutely no problem. You can take that home and you can assume that that will happen for the next 5 to 10 years for sure. So you can have a great fixed income investment at your disposal. So with that, I want to close this formal session.